Live from New York City this morning. Good morning, good morning. Adding to the rally of last week on the S&P 500, up by about 0.75%. We'll go stateside in just a moment. We'll start in the UK, where it looks like Rishi Sunak is the country's next Prime Minister. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City this morning. Good morning. We start the morning in the United Kingdom and head over to Lizzie Burden in London. Lizzie, awaiting the next Prime Minister, and it looks like we've got an answer.
Yes, Rishi Sunak is going to be the fourth Prime Minister in 3 years in the UK. We've just had a statement from Penny Mordaunt. She says, we have now chosen our next Prime Minister. This decision is a historic one. It shows once again the diversity and talent of our party. Rishi has my full support. This race had dragged on to the very last moment. It is literally the last moment. And with it seconds to go, she has tweeted. But it seemed, John, that she just did not have the backing of the parliamentary party. Rishi Sunak had got the majority of MPs, and it was looking like Penny Mordaunt was going to face exactly the same problems that Liz Truss faced in not being able to get her agenda through Parliament. And at the very last moment, it was clear that she could no longer profess to be the unity candidate in this race.
Lizzie, the price action pretty clear. Yields down by 20 basis points at the front end on a 2-year. That's been the story all through the morning. Sterling outperforming relative to its peers in G10 against the US dollar, unchanged on the session at 113. Danny Berger joins us now as well. Danny, talk to us about policy here, what we can expect from Rishi Sunak, formerly the Chancellor and now the Prime Minister.
Well, I was just about to say, John, we don't have a clear outline of where he goes from here, but it's pretty clear where he will go, considering he was just Chancellor. Now, it's likely that this will usher in a new age of austerity, something that Jeremy Hunt has compared Rishi Sunak to the tough decisions that Maggie Thatcher made in the 1980s. The emphasis has been one of balancing the books. So it's about higher taxes. It's also about less spending. But of course, they face a calamitous economic environment that structurally will leave the UK in a very difficult situation. So at the moment, policy, it's about playing it safe. It's about stability, John.
Lizzie, let's talk about what comes next now. We were expecting a fiscal statement at the end of this month, in the next week. We were expecting a Bank of England rate decision in early November. How do the events of today shape the events still to come?
Well, I think part of the reason that Rishi Sunak, the main reason that he has been is being anointed by MPs as the Prime Minister is because of his economic experience. Therefore, he knows the fundamental importance of reassuring the markets now, first of all, that Jeremy Hunt is going to remain the Chancellor, and secondly, that this medium-term fiscal plan is going to go ahead on October the 31st, ahead of that BOE decision on November the 3rd. As Danny says, he's going to face, in the words of Jeremy Hunt, the Chancellor, eye-wateringly difficult decisions between spending cuts and tax rises, but he still does need to plug this £40 billion hole in the public finances if he's going to reassure the markets.
Danny, I have to say, for a lot of people in the United Kingdom, they're very focused on who the next leader is. In the United States and beyond, it was all about the market of the last couple of weeks. Danny, do we just move on from the gilt crisis, if you can call it that, of the last month or so?
Well, Kit Jukes this morning was talking about the idea that he would be selling volatility now, that we're going to move away from an environment where we're just lurching from headline to headline. So, yes, volatility might be lower, and you can hear around here volatility is still very present with protesters still screaming in the background of me, John. But it doesn't mean that UK gilts will go higher from here. It doesn't mean that the pound will strengthen. They still face the problem of, as Lizzie says, this hole in the budget of higher and more expensive energy and rates that are set to rise, perhaps less now than they were when we had Truss at the helm, but they still need to move higher to fix the structural issue of a weak pound.
Just hearing from the 1922 committee chair, Graham Brady, as we expected. Sunak is the sole candidate in the Tory leadership contest. Rishi Sunak is the leader of the Tory party. As such, Rishi Sunak is said to become the Prime Minister of the UK. Lizzie, will hear from Sunak. He will address the MPs, the Tory MPs, at 2:30, I understand, 2:30 local time. What are you expecting from the rest of today?
Well, all the plans have been blown out of the water. We could get a statement from Rishi Sunak, of course, as he's going to want to reassure the markets of what's coming next. We're going to find out who's going to be in his cabinet. As I say, we're likely to get Jeremy Hunt continuing in his role as Chancellor. Will Grant Shapps stay in the cabinet? Will he actually stay as Home Secretary? What you need to see from Rishi Sunak now is reaching across the huge gaping divides in his party to build party unity now. He had the backing of big names like Dominic Raab, Boris Johnson's former Deputy Prime Minister. In fact, that was a significant moment in all of this when he chose to back Rishi Sunak over Boris Johnson, who of course dropped out. Will there be roles for others like the former Chancellor Nadhim Zahawi? Very important in terms of not just party unity, but political stability, and then, of course, the economy too.
Lizzie, thank you. Lizzie Burden, number 10 Downing Street. Danny Berger over in Westminster. Rishi Sunak confirmed, set to become the next Prime Minister in the UK. After a month of following this mess in the market, joining us now is Invesco's Brian Levitt and Jared Woodard of Bank of America. Brian, are you confident you can just ignore what's happening in the UK now and move on?
I don't think we can ignore it. I think we can have a little bit more comfort. I mean, what we've seen is a return of the bond vigilantes for the first time in a very long time. And so the message to Liz Truss was, no, we're not going to increase. We saw what happened in the UK gilt market, what happened in the pension system, the pension funds. This does remove some of that uncertainty, which is certainly good, for lack of a better word. But the UK still has challenges. I mean, it's still a very weak growth environment, high inflation. So there's still challenges to address. But this does start to remove one form of policy uncertainty there.
Jared, what's the lesson from the last month?
Well, John, I think it's a great piece of evidence that we're undergoing a massive shift right now from a 2% world, 2% inflation, 2% central bank targets, and so on, back to the 5% or so world that we were familiar with for most of the 20th century. Bond volatility is evident in the UK, but it's also evident in the United States. Currency volatility around the world. Look at the yen. This is a shift that's incredibly profound. It's slow moving. It won't be done soon. I think it has profound implications for asset allocation. And the news out of the UK is just more evidence that the environment from, say, the year 2000 until 2019 or so, that was the aberration. I think we're returning now back to something much different.
Jared, I heard from Chris Verona of Strategas earlier this morning. He said to us and the team at Bloomberg Surveillance that the first scalp of this new market regime was Liz Truss. Then we started to discuss who's next. Jared, who's next?
I don't want to make a political prediction, John, but I think one scalp you've also seen are 60-40 investors, are growth investors who've all become, I mean, by our estimate, there's about $70 trillion of assets in the world today priced for this 2% regime. Those valuations have to adjust. Those cash flow and discount assumptions have to adjust. And for us, that requires lower market multiples, more volatility, both in the macro and the market side, and a shift in asset allocation that we have yet to see.
I wouldn't expect you to make a political call, maybe a policy call. Jared, I was thinking more along the lines of, is the BOJ the next to capitulate on their policy? We've seen the markets return to providing some form of discipline to bad policy. Is yield curve control in Japan bad policy?
When you look at the yen, it's hard to avoid the question whether the Bank of Japan is going to continue to run basically solo as the rest of the world tightens and deals with problems from inflation. I would be very shocked if a year from now it wasn't clear that inflation in every country turned out to be much more difficult to contain than I think most policymakers still are prepared to address. And that means for investors, more volatility in the bond market, a rethink of asset allocation, and a shift toward assets that can produce cash flows now rather than relying on low discount rate assumptions for growth in the future.
Brian Levitt, where do you look for policy capitulation next?
I actually think you may start to see it from the U.S. Federal Reserve. I mean, we've already priced in a 5% terminal rate. So I'll go the other way on this. Yeah, you might see further tightening in places like Japan, places that need to catch up. But the U.S., we already have a 5% terminal rate. And the economy, if you look at financial conditions, if you look at ISMs, is heading towards contraction, which is below trend growth and decelerating. So we've got the timing messed up a bit here in the United States. Typically, when you're in a contraction, the Fed is beginning to ease. We don't have that right now, which has certainly been challenging for markets. But in my opinion, as inflation is going to start to come down, you're going to see the Federal Reserve have to hit a pause button. And what you're likely to see is markets start to get ahead of that pause. So I actually think it's a positive capitulation that's likely coming over the next months.
Brian, is that what we're already seeing Friday and into today's session as well, off the back of a Wall Street Journal story that told us everything I thought we already knew? They said the following: Federal Reserve officials are barreling towards another interest rate rise of 0.75 percentage point at their meeting November 1 to the 2nd, and are likely to debate when and whether they should signal plans to approve a smaller increase in December. Now, Jared, the conversation we're talking about now is the step down. It was the pivot, then it was the pause, and now it's the step down from 75 to 50 and maybe to 25. Jared, is that bullish?
I don't think it's bullish yet. Our view at Bank of America is for a peak of 5% in the Fed funds rate in the first quarter of next year. And I always tell investors it's very easy to get too ahead of yourself here, because the effects, as the Fed is always at pains to point out, the effects of tightening policy take a long time to feed through to the real economy. We haven't yet seen, I think, the move in credit conditions and financial conditions that we will see if the Fed gets all the way to 5%. And you have to allow time for that to filter through to the real economy, to corporate earnings. We have yet to see a really bad quarter of corporate profits. And we haven't seen the kind of investor capitulation. All these conditions are missing to give us a big low in the market and to coincide with a pause in the Fed.
Brian, to Jared's point, and it's an important one, we've priced in the hiking cycle. We haven't priced the weakness, the economic weakness associated with it just yet. Are you jumping a couple of steps too far?
Well, my sense is to say that, it doesn't happen immediately, but I would use 81 as an example. Inflation peaked in 1980. You had a recession in 81. Some more challenges for the market through that period. But if you had invested in when inflation peaked, in fact, if you had invested when inflation peaked in any of the cycles, you were quite happy a year or two later. So it's not to say that we've hit bottom. There's some near-term challenges here. The question is, are you optimistic about stocks over, call it, the next 6 months to 24 months? And I would be. With regards to the valuation adjustment, look, we came into the year at 30 times earnings. The market believes, or the analysts believe, earnings get to around 220. That has us today at around 16 times forward earnings. That's not overly expensive. Now, will earnings be hit in a recession? Yeah, they'll come down, call it 10, 15%. But what multiple are you willing to pay on that? Even if you fall to 180 on earnings per share, what are you willing to pay on that? If you're willing to pay 17, then maybe we've got to see 3,200. If you're willing to pay 18, 19, then maybe we're starting to put in a bottom. But the key point is markets tend to do well after inflation peaks, even if there is an earnings recession in the interim.
Hey, Brian, stick with us. Brian Levitt, Jared Woodard. After the latest news came through from the United Kingdom that Rishi Sunak is set to become the UK's next Prime Minister, we can turn from the political certainty, if you can call it that, in the UK to the uncertainty on the horizon in the United States. Coming up, President Biden with a message for American voters.
If you're worried about the economy, you need to know this. The Republican leadership in Congress has made it clear. They will crash the economy next year.
Counting you down to the midterms, that conversation up next.
If you're worried about the economy, you need to know this. The Republican leadership in Congress has made it clear. They will crash the economy next year by threatening the full faith and credit of the United States, for the first time in our history, putting the United States in default unless we yield to their demand to cut Social Security and Medicare.
President Biden warning of the economic consequences if Democrats lose control of Congress. Speaker Pelosi defending her party's pandemic spending, saying she has no regrets.
No, absolutely not, because that was necessary for people to survive. The point is that when you reduce unemployment, it's inflationary. That is a fact. The fight is not about inflation. It's about the cost of living.
This is the latest polls show Republicans gaining momentum on key issues with less than 3 weeks ahead of midterms. Bloomberg's Anne-Marie joins us now from the White House for more. AMH, change the subject, change the topic, was the message from Speaker Pelosi.
That's right, and they're going to be talking about the economy. And why is that, Jonathan? Because you just showed the latest poll, but it's been poll after poll lately that the economy is top of mind for voters. You're going to hear more of that rhetoric today. The president will be speaking at the DNC headquarters. In that last speech, he called it mega MAGA trickle down, and he's likely going to say that again. When you look at the New York Times Siena poll, Jonathan, an issue like abortion that the Democrats really wanted to get the vote out for, that is starting to lose some momentum. Unlikely voters. It says the economy, 27%, inflation, 18%, and then abortion, 5%. And that same poll shows that those voters plan to vote Republican. So a lot of the analysis that the House for sure will go red. Greg Vallier today in AFG, in their perspective and their final prediction, says they're just not sure how big of a wave is going to be, but it's going to be a red wave. He also thinks the Senate will go red. But Cook Political Report says that is still a toss-up, but many people are starting to lean that potentially they are able to pick up that one seat.
The sprint to the midterms, I guess, starts right now. AMH down in D.C., thank you. Brian Levitt, Jared Woodard back with us. Brian, let's start here. You've been thinking about it. You've been researching it. Do politics matter? Yes or no?
Well, politics tend to not matter nearly as much for markets as investors suspect it does. I mean, start with the economy. If you look at the median real GDP of the U.S. economy back to 1946, it's very similar. Single party rule on either side versus divided government. If you look at markets over time, markets tend to do well regardless of the combination of government. I mean, the long-term advance in the U.S. market has done well across many different administrations and different combinations of government. So it doesn't matter to the extent where investors are always saying, well, I'm going to get out of markets if this politician wins or loses. I strongly advise investors against doing that. Now, are there some challenges here? Yeah. I mean, you hear President Biden talk about raising the debt ceiling. I suspect we ultimately will do it as we have in the past, but certainly create some policy uncertainty in the near term, which markets don't love.
Jared, your take?
We know that historically investors appreciate when there's a little bit of friction in Washington. Too smooth of a path, too much control, by either political party can lead to some pretty aggressive, policy entrepreneurialism, let's say. And I think it's no secret that some of the massive stimulus that we did last year in particular may have exacerbated the problems we're seeing now when it comes to inflation. So a bit of let's say gridlock or at least a little more friction, a little more negotiation, I think is likely to be greeted by investors as a big positive next year.
Brian, when I hear people say things like politics don't matter, this is the data, look at the post-war data, I wonder if the post-World War II data says more about the American century than it does anything else. And as that century comes to a close and you start to see the emergence of China solidified by the actions of Xi over the weekend, whether the policy decisions, the politics start to matter a little bbit more in the way they didn't in the previous 50, 100 years.
No, I don't suspect they do. I'm not sure that we're ready to give up the mantle of, the world's great economy superpower. China's obviously grappling with their own issues right now. And markets over time, I mean, if you think about it, Jonathan, we look in hindsight, the 20th century, 2 world wars, a Great Depression, a dozen recessions. It's not as if it was easy going. Markets don't trade on good or bad. They trade on better or worse. And so you have to ask yourself, are things likely to get better relative to expectations over the next couple of decades, irrespective of who's running the executive and legislative branches of government?
Jared, do you think they are set to get better?
Well, I do think that the resurgence of some measures, especially in the United States recently, to bolster our industrial base in this country, to boost energy production, to the Semiconductor Chips Act and these kinds of measures, to preserve competitiveness and to raise productivity. These can be incredibly powerful. They're incredibly positive. A lot of folks know that some of the big innovations in technology of the past few decades, think about smartphones, were all funded by industrial policy in the Cold War designed to produce some military innovations, and the second order and third order effects of that gave us a lot of incredible technology. If we can pursue that sort of agenda today, whether it's with regards to China or energy challenges there's a lot of knock-on effects to productivity that can be incredibly bullish.
Well, Jared, what's the energy opportunity right now after the monster rally we've had in fossil fuels and those producers in the energy patch, the likes of Exxon, the other oil producers as well elsewhere?
John, I think there's deep value in natural resources, energy, and miners. If you look at clean energy stocks today, they're trading at 27 or 30 times earnings. If those companies succeed, it requires copious amounts of raw materials, lots of energy to power the grid, and the energy stocks and the mining stocks that are necessary for clean energy stocks to work, those are trading at 8 times. So I think despite the rally this year, most investors don't own that much in energy. You're going to need lots and lots of fossil fuels as a bridge to the future, lots more mining, lots more raw materials, and those stocks are, I think, trading at fantastic valuations.
Brian Levitt, final word here, sir.
My final word is that we're going through a very, very challenging environment because it's a unique pandemic cycle. And I would advise investors not to extrapolate this as being the rest of our lives. We had a pandemic where we shut down the global economy. We provided too much stimulus across both administrations. It's created an inflationary environment, policy tightening. We're trying to get through that. The good news is long-term inflation expectations are not out of whack. The Fed does not appear to have lost credibility. We will get through this. Right now, we're contracting and tightening. That creates some challenges. A recovery will commence next year, and investors tend to do well investing in that recovery.
That's the constructive view. Brian Levitt, thank you, sir. Alongside Jared Woodard, to the both of you, awesome, as always. About 7 minutes away from the opening bell, equity futures up by 0.5%. Coming up, the morning calls, and later, investors gearing up for a big week of tech earnings. Battlesoc's Emily Hill expecting a strengthening dollar and rising rates to fuel further downside in equities. That conversation coming up shortly. Your opening bell, just around the corner. Looking to build on the rally of last week. Equity futures up by 0.4% on the S&P. On the Nasdaq, pretty much unchanged. That's the price action. Here are some morning calls. First up, Wells Fargo downgrading FedEx to equal weight, expecting weaker revenue growth as the company pivots towards cost-cutting measures. Next up, Citigroup initiating coverage on Harley-Davidson with a neutral rating, seeing macro headwinds weighing on demand for at least another year. And finally, Bank of America downgrading Meta to neutral ahead of Wednesday's results, seeing mounting headwinds to upcoming earnings estimates. That stock is down by a little more than 1%. Coming up on this program, Alphabet and Microsoft earnings on deck. Battlesoc's Emily Hill expecting a strong dollar to play a big role in big tech results. That conversation coming up with equity futures on the S&P 500 up by around about 0.4%. Your opening bell to kick off the trading week is just around the corner. Live from New York City this morning. Good morning. About 22 seconds away from the opening bell. Equity futures elevated by about 0.5%. Last week, monster week of gains. Biggest week of gains since June on the S&P 500. Looking to add to it right now. On the Nasdaq, basically unchanged. The Nasdaq helped out by a big move lower in bond yields on Friday. Switch up the board and get to the bond market. Yields look like this. Your 10-year yield was lower. Now it's basically unchanged. 422.55 on a 10-year. In the FX market, the numbers out of Europe today were dreadful. And if I told you a few months ago, let's call it 6 months ago, the start of the year, say, that you'd get some PMIs in the 40s in Europe, and that same week you'd get a 75 basis point hike from the ECB, you would not have believed me, but that's what we're set to do on Thursday. Futures then were positive going into the opening bell. Coming out of it, the stock market is elevated on the S&P 500 about 25 seconds in. We are positive 0.4%. On the Nasdaq, basically unchanged. The equity rout in China is what we started the day with, though, and it bleeds into the US Open. US-listed Chinese tech stocks under pressure ahead of a busy week of earnings from some of the world's biggest companies. Ed Ludlow off the back of the events in China over the weekend.
Yeah, good morning, Jonathan. We're down 11% on the Nasdaq Golden Dragon Index. That is a gauge of US-listed Chinese technology shares. Look at 4 names in particular. Pinduoduo, Alibaba, JD.com, Baidu, they make up 33% of this index. There are 2 concerns, right? First of all, from a policy perspective, that after consolidating power, Xi Jinping will not be supportive of private enterprises' recovery in an economic sense. The second line in that is also COVID zero policy, right? That having consolidated power it kind of hits the hope that we will see some support for an economic reopening. Overnight, I was paying close attention to the Hang Seng Tech Index dropping 10%, its biggest decline since March, closing at the lowest level since 2016, taking its year-to-date decline beyond 50%. Basically, John, tech in China has firmly established itself now as the laggard for that sector globally from an equity market perspective as well. We also got a slew of economic data overnight. A mixed bag. The economy grew faster than expected in the third quarter, but retail sales weak and the property sector continues to be a concern. China home prices sinking for a 13th month in September. That market remains fragile, and it's going to be a major challenge for Xi Jinping going forwards.
Big challenge for us in this market as well. Ed Ludlow, thank you, sir. I mentioned this a little bit earlier this morning. I think it's worth repeating. There aren't many things you can be confident of at the moment, but I think we can be confident of saying the following. We're more likely going to be talking about the events over the weekend in China in 10 years to come than what's happening in Westminster right now, without a doubt. And you can see that reaction in the equity market for Chinese tech stocks. That's speaking loud and clear. And the currency weakness as well is a big, big deal we'll stay on top of through the week. 1/3 of the S&P 500 reporting results this week. Bloomberg's Taylor Riggs takes a look at the earnings still to come. Hey, Taylor.
And John, so we've gone about 100 earnings within the S&P 500 reporting, and about 70% of those have actually seen an improvement relative to consensus. So you're a little bit below the 5-year average on that statistic, but I think that overall everyone would say that this certainly has not shaped up to be a horrible season so far. As you can see there, year-over-year earnings growth a little bit light, but sales is an improvement year-over-year. And then again, relative to estimates on both the bottom line and a little bit here on the top line, there is some improvement. We're going to get a lot this week, John. Like you said, it's going to be a big week. Tuesday and Thursday are sort of the biggies when you think about Microsoft on Tuesday, Apple, Intel, Amazon on Thursday. So that will skew it. But big tech, and of course, given the weighting within the S&P 500, certainly going to give us an idea of how we're going to be wrapping up at the middle portion, at least, of this earnings season. What I love about earnings season and the quarterly season is the back focus on the fundamentals, John, and that is what is driving the market. Remember that we're down 20% year to date on the S&P 500. But since quarterly reports really started in earnest about 10 days ago, the price action is still up actually about 2.3% on the S&P. So again, a refocus here on the fundamentals, on the actual companies here, and maybe that will start to drive some of the price action.
Taylor Riggs, thank you. Wonderful as always. Catch Taylor at the close to break down some of those earnings later this week. BNY Mellon's Alicia Levine saying their valuations for big tech still have further to fall.
High growth names, when they stop growing high growthly, get not only an earnings downgrade, but you get the multiple compression as well. So to the extent that you have stocks that are still trading at 40 times next year's, the tech names are still too high.
Mabasok's Emily Hill seeing further downside for stocks, writing the following. The current challenging environment is separating the sheep from the goats. We may not see the true impact of a strong dollar, higher interest rates and rising labour costs until the fourth quarter. The S&P is likely to retest the lows in early 23. A retest of the lows in early 23. Emily, fantastic to catch up with you. You said on valuations, stocks are not yet undervalued. What will guide that ultimate conclusion?
Well, the S&P 500, at least large cap stocks, are trading at 15.6 times forward earnings. And so that's a reasonable value, but they're certainly not a huge bargain. So I think what we're in the middle of right now is our second testosterone-driven bear market rally. And I think there is still a ton of liquidity out there, and the market is looking for any signs that the Fed might pivot and has latched on to those. The market has latched on to those recent slightly dovish indicators by some members of the Fed. And so I think we're in the middle of another rally that could possibly continue towards the end of the year. Now, this would happen if we don't see some of the global headwinds that we're all well aware of reflected in the earnings reports this quarter. So it may take until fourth quarter reports for the downturn in some of these big growth stocks to actually come to play.
Emily, I'm with you. We had the pivot, then it was the pause, and now it's the step down. This conversation about going from 75 to 50 to 25. I read the Wall Street Journal article, like pretty much everyone else who read the Wall Street Journal article, and I saw a bunch of quotes that I've already read from several Fed officials. Not much there. But Emily, I did think, is there something to learn from how the market responded to it? Does that tell you something about positions being caught offside, that maybe we were leaning too much to the one side of the boat, if you will? Is there anything to learn about how we responded to that story on Friday?
You mean leaning too
bearish
on equities, too bearish on bonds?
Well, I think part of the issue is that, you know, we've seen expectations for earnings decline by more than they did in the early stages of the pandemic. So the bar is quite low, and it's not going to be difficult to get over that bar. You know, I mean, it's better than a dumpster fire. And that's apparently positive. So, you know, the answer is we may be leaning a little bit too on the bearish side. But, you know, I think a lot of this optimism is unwarranted. And I just think there's a huge amount of liquidity out there and people just looking for, we still haven't seen good prices in large cap US stocks.
Mike Wilson called for a tactical bullish rally last week. This is what he had to say after the weekend. Last week's tactical bullish call was met with doubt from clients, which means there is still upside. Falling inflation expectations can lead to lower rates and higher stock prices in the absence of capitulation from companies on 23 EPS guidance. I keep hearing from the equity bears, Emily, that weakness they expected could come maybe in the next quarter. So you hear from these companies in early January. In early 2023. What is it about the view that I think really started in the summer that we'd get this capitulation on earnings, and we've been pushing it back out and further out, and the earnings are starting to come through for Q3, and I hear it again. Yeah, no weakness just yet. You're starting to see cracks, but the real weakness you'll see in 3 months' time. What is it about 3 months' time that we'll see that real weakness?
Well, Mike Wilson is hedging a bit, and, you know, and perhaps I am as well. But I do think, you know, we had a very strong labor market. We've got strong consumer demand that is taking a while to decline. We're starting to see that now. We're just starting to see house prices decline. So some of the factors out there that will negatively affect earnings haven't really come into play. And so Mike Wilson's thesis is that we're going to get a tactical rally up to 4,100, maybe even 4,200, and that it's actually a tradable rally. But once all of these factors do begin affecting large US companies, then we're going to see the true earnings carnage in the fourth quarter. Now, I am not as bearish as he is, but I think that he's often, you know, if not usually right. And, you know, it may be that he just wants to defend the thesis that he's put forward for the last year and a half. But I think, you know, I'm on his side here.
He seems to have a crystal ball that I don't have, and it's still working based on the call of last week and the rally we had last week too. Emily, wonderful to catch up with you. Emily Hill there on the equity market, and Mike Wilson's view of the world as well from Morgan Stanley. Here's the view of the market right now. Last week, biggest week again on the S&P 500 since June, and we add to it on the S&P up 0.8%, 3783 on the S&P 500. The Nasdaq comp up by almost 0.8%. Coming up on this program, world leaders warning Russia about escalating the war in Ukraine.
They have chosen to be Western, they've chosen to be democratic, members of the European family, and we have to defend them as long as that's what they wish to be.
That conversation up next.
They have chosen to be Western, they've chosen to be democratic, members of the European family, and we have to defend them as long as that's what they wish to be.
Russia's defense minister calling counterparts saying Ukraine is preparing to use a dirty bomb. Western leaders rejecting the claim, with the US Secretary of Defense Lloyd Austin tweeting the following: I spoke with the Russian Minister of Defense on the phone. I rejected any pretext for Russian escalation and reaffirmed the value of continued communication amid Russia's unlawful and unjustified war against Ukraine. Your team coverage starts right now. Bloomberg's AMH back down in DC alongside Maria Tadeo in Brussels. Maria, talk to me about the phone calls that took place over the weekend.
Well, Jonathan, it is very interesting because you did see representatives of the United States, the United Kingdom, and the French on this phone call with the Russian Defense Minister Shoigu. Now, we haven't seen that kind of diplomacy in months. In fact, the diplomatic channel in many ways is dead between the West and the Russians. Having said that, when you look at the content, well, not a lot of detail, but also nothing new. They still say you are the one that's escalating. Of course, the Ukrainians deny the fact that they plan on using any type of ammunition to self-sabotage and escalate the war on the ground. And the Russians continue to say the problem here is Ukraine. What I would note, which to me was more important, in fact, more relevant, over the weekend, a speech by Emmanuel Macron yesterday from Rome, in which he said the Ukrainians ultimately will have to decide the time and the terms of this war. So it does seem to me that a lot of the officials here in Europe still believe we're far off from a diplomatic solution, and this war is still in a very active phase.
AMH, we talked about the midterms about 20 minutes ago. Can you discuss how this is playing out on the campaign trail ahead of those midterms?
It's a great question, Jonathan, because last week we heard from Kevin McCarthy, the House leader for the Republicans. He is set. If there is this red wave, especially in the House, he will be the speaker. And he had said that this next Congress, there will not be a blank check for Ukraine. He said there's going to be Americans that are sitting around. They're going to be potentially in a recession. They're going to be concerned about rising costs of gasoline, of food prices, and their rent. And there's not going to be this blank check for Ukraine. This is something that many of, I would say, core Republicans, like you have Mitch McConnell, really wanting to make sure they are showing that united front. For a while, foreign policy when it came to Russia's invasion of Ukraine and making sure the humanitarian, financial, and military aid in terms of weapons, tens of billions of dollars being sent to Ukraine, there was a lot of bipartisan support. Potentially, what you're hearing from Leader McCarthy is that there is going to be some potential new members of Congress that are not going to be on board with that.
Maria, is it playing out in quite the same way in Europe?
Look, it's a very good question because, of course, by now everyone knows the war in Ukraine, not just a war, but the reconstruction of this country, the damage that's being done to the east of Ukraine is going to cost billions. Some even suggest you're getting close now to $1 trillion. Tomorrow there is a conference for the reconstruction of Ukraine that will happen in Berlin. As the German Chancellor Olaf Scholz who will head this. But now this is bringing up a debate which was put to the side. But I predict this is going to be a big topic here in the European Union going forward, which is the cost is massive. It's enormous. What do we do with the Russian frozen reserves? Should we use that money to pay for the reconstruction and the war, considering, by the way, that for a lot of Europeans, they now see this inflation manifesting pretty much on everything, across everything, every day. So the money question definitely gaining momentum also in Europe.
Maria, can we finish on the good news? The good news is out there, and it's the weather. This from Javier Blas a little bit earlier this morning. Unseasonably mild weather in Europe continues to push down gas and electricity prices. Maria, we can joke about the weather, but how important is that?
Well, this is everything. I mean, it's not a joke. I was walking, by the way, with a sweater today in Brussels at the end of October. That is unheard of. Yesterday was a pretty hot day, I have to say. And for a lot of European, well, diplomats and officials, this is the key. They really believe if the weather can hold on like this for 2 weeks, there really could be a game changer. And I can tell you, a lot of the diplomats that I know are praying to God, any God, that the weather stays like this.
Maria, thank you. Maria Tadeo over in Brussels, AMH down in DC, to the two of you. Absolutely wonderful, as always. On the S&P 500 right now, about 18 minutes into the session, we're up by 1% on the S&P. On the NASDAQ, up by around about 0.1%. So the rally continues. I talked about the weekday trade of Europe a little bit earlier this morning. The PMI's in the 40s, and the ECB still expected to hike 75 basis points this Thursday. Just got some PMI data out of the United States. With those data points, that news, here's Mike McKee. Hey, Mike.
John, we have some really bad news from the PMIs in the United States. This is the S&P Global PMIs, used to be market. We talked about how bad the British PMIs are. Well, the U.S. ones, are worse, a couple of them. The manufacturing PMI comes at 49.9. That's down from 52. So we've gone into what is theoretically a contraction number. Services, 46.6. This is the one that was holding up, and it has fallen significantly. The UK services PMI was 47.5, better than in the US, and the US composite 47.3. That's just a tick higher than the 47.2 in Great Britain. So while Rishi Sunak has a big job ahead of him, Joe Biden's got some problems as well. This week, we don't get a lot of data that will be definitive for the Fed, which meets next week, but we do get some idea of how people are feeling about it, because we get consumer confidence numbers from the Conference Board on Tuesday and the Michigan sentiment numbers on Friday. The biggest numbers of the week are going to be the ECI, the Employment Cost Index, and the income spending numbers and PCE inflation on Friday. Those are the ones that might move the markets, if not the Fed. John, I do have one bit of bad news for all of your audience and your investors out there.
Go on.
It appears a recession has moved significantly closer.
Brutal.
The Philadelphia Phillies are in the World Series, and every time a Philadelphia team has won the World Series, we have had a financial crisis.
Are you saying the choice is then between supporting the Phillies or the Astros? And I was told all through this morning that everyone hates the Astros, Mike. So for the economy's sake, do you have to support Houston?
The economy would suggest, based on past history, that you have to support Houston. Maybe some people will hope for a break in that string, but it doesn't look good when you look back.
I still don't get it. Yankees fan are going to support the Phillies, Mike. Is that right?
Well, they're different leagues, so Yankees fans could support the Phillies.
So they'll do
and
that.
Yankees fans hate the Astros because they
Astros.
cheated in 2017.
Okay, but they keep on winning as well.
Yeah.
I get it. Mike McKee, thank you, sir, as always. The PMIs, ugly in the United States. Will they be confirmed by the ISM? And Mike's covered this a few times for us over the last few months. That's not been the case yet. The PMIs in the United States, not great. In Europe, pretty dreadful. This market action, though, Abby, something for everyone. Pretty bullish out there, isn't it?
It is pretty bullish. And you were mentioning earlier that last week was the best week since June. The rally continues. And interestingly, it's a defensive sector, though, that's leading today. That is healthcare up 1.5%, followed by staples. So two defensive sectors leading the way, then industrials, financials, utilities, real estate. So to your point, pretty much all sectors higher. Again, something for everybody except consumer discretionary, down ever so slightly. And I'm guessing that is on Tesla. The last time I looked, down about 4%. But the real weakness has to do, of course, with China tech, as Ed Ludlow had outlined before. If we take a look at the Golden Dragon Index on the day, it is absolutely plunging. Its worst day ever, down 17%, going back to 2001. Its lowest level since 2013. The Hang Seng, as you know, had a bad session. Chinese tech had a horrible session, so we're really seeing that follow through today. Alibaba, one example, down 15.6%. Another interesting place that we're seeing that weakness, John, the New York FANG index, because many of the movers in that index are also the China tech names. So lots of weakness there, and it's going to be interesting to see. We have this bullish action in the U.S., but this weakness for China. Which way will that divergence go between the world's largest economy and the second largest economy?
It's a great question, Abby. Thank you. You see the weakness in the equity market, the weakness in the currency. The team here at Bloomberg rounding up the story. Here's one quote I'll pick out from that story for you. This from the head of investments at HB Investments. The concern is that absolute power may lead to harsh policy both locally and internationally. On a local level, zero COVID policy or tougher regulations on China tech may not go away. This individual, Sharif Faha, went on to say, on an international level, the market is definitely concerned about political tensions. And I think that was the question we all asked ourselves this morning after the events of the weekend. Does it make it more or less likely that COVID zero continues? And most of you, I know, concluded that it makes it more likely. Coming up on this programme, your trading events, your trading diary is up next. What a week ahead we've got for you, particularly on Thursday. ECB rate decision, a ton of earnings. I think we get the Credit Suisse review, strategic review as well, a little bit later this week on the same day. That's up next from New York. This is Bloomberg. So earlier this summer, we had a nice chat about the pivot, the pause, then it's the step down. I think we've done the step down twice already in the last couple of months. Is that an excuse or a reason for this rally? That rally continues, by the way, up another 1% on the S&P 500, off the back of a big week of gains last week on the S&P, the biggest weekly gain on the S&P going back to June. That's the equity story in the bond market, 2s, 10s and 30s shaping up as follows. Your 2-year at 20 basis point range on Friday. Ridiculous stuff. Through 460, back down to 440, right now down about a basis point to 446.18. Last week on 10s, 10-year yields closing out the week for a 12th consecutive weekly gain. Just absolutely ridiculous stuff in this bond market. That's the price action. Here's the trading diary. Your week ahead looks like this. A big week of tech earnings. You know that. Alphabet and Microsoft on Tuesday, followed by Meta and Twitter on Wednesday. Finally, results from Amazon and Apple on Thursday. What a Thursday we have for you. Claims, GDP, take your pick. ECB rate decision on Thursday. And we close out the week with the BOJ, US personal income and spending numbers, core PCE and the UMich Consumer Sentiment Survey. Is that enough for you? From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.